to everyone. It was nearly 15 years ago, when the economy and the banking sector were at rock bottom, that I found myself getting into a taxi in London to go to the airport. As we drove off, the driver asked, "So what do you do?" He knew what I did because I'd just come out of the headquarters of my bank. I was dressed for the part, but I hesitated as I thought, if I tell him I'm a banker, he'll give me a lot of grief. It's been a long week. I really don't need that. But I had to say something. So I replied, a little tongue in cheek, "I'm a banker, but one of the good ones. In fact, most of us are good ones. So please don't pull the taxi over and make me get out." He responded, "I understand why you hesitated. Maybe you read in the papers last week about the taxi driver who was arrested for assaulting a passenger." At which point I thought maybe I should ask him to pull over and let me get out. But I stayed in the taxi, and on the way to the airport, I sat there thinking that there must be some way for bankers to do something for themselves, to be able to speak up for themselves and begin to re-earn trust. I start with that story from 15 years ago because it lets me look forward at what changes have happened within banking since and what's coming along. The global financial crisis of 2008, the GFC, was a watershed moment for the banking industry. It forced us to reevaluate our practices, our ethics, our culture. Banks exist to support economic activity and create and protect personal wealth. For some years, however, as banking became increasingly digitized, bankers deferred to the speed and apparent accuracy of the algorithms being created to quantify risk, to target marketing, to increase productivity, losing sight, perhaps, of how banking should be delivered, ignoring the how in favor of the what. Inquiries, public scrutiny, and navel-gazing followed the GFC. Banking regulators stepped up to the mark and enhanced the focus, rigor, and scope of their regulation. Indeed, today, on the back of major change, banks are now disciplined by a capital ratio. Banks globally can withstand far greater losses than ever, and the system can better withstand failure. Interbank lending has fallen by 2/3 since then, so banks are far less dependent on each other, and complexity, especially in the derivatives market, has been greatly reduced. But going back to that point in time, even knowing such transformation would come, and led by the Chartered Banker Institute, some of us believed that regulation alone wasn't enough, that change had to come from within the industry as well. Regulation provides tramlines in relation to current issues and tries to anticipate the future. But just like algorithms, regulation alone can't ensure that good judgments are made by every banker in every situation. Regulation only takes us part of the way. So we put our heads together and developed a framework for professional standards for bankers. The first time this had been done not just in the UK, but anywhere in the world. After all, the sector has a license to operate. It requires expertise and knowledge, and it's asymmetric in that bankers have more knowledge than their customers. These aspects make it a profession, even if we still call it an industry. Professional standards lead us beyond regulation and help us be accountable to customers, colleagues, and counterparties so that banking can deliver for the public good. Aiming to rebuild public confidence in banks and bankers, we also enhanced the Institute's Code of Professional Conduct, underpinning high ethical, professional, and technical standards. Over 1 million bankers and others have engaged with the code and standards, a big cultural change over the last 10 years, and a massive influence on our organizations. The regulator has kept moving as well, most recently introducing the consumer duty, which sets higher expectations for the standard of care that firms provide to consumers. Still in the early stages of rollout, it'll have significant impact on culture and banking. Now, if the Institute's Code of Professional Conduct is about each of us as individuals, and regulations such as the consumer duty is about the responsibilities of our firms, organizational culture is the space that sits between. Culture is often defined as how we behave when no one's looking, but actually it's about how we behave when everyone is looking. Your organization likely has values, and you'll have values as an individual, but culture is about a group of people. Culture reflects what's admired in a group at any point in time, and also what's deplored That's what brings us to act the way we do at work. So why does culture matter? Well, in an organization, people can make just about any strategy work, and they can circumvent almost any strategy as well. How often do we hear the phrase, culture eats strategy for breakfast? It's the culture in the organization, whatever the value statement pinned up on the wall, which makes the difference in terms of implementation of strategy. It's the culture which will lead to the consumer duty having impact. It's the culture which will encourage our colleagues to act professionally. It's culture that makes the difference in terms of trustworthiness. On the back of game-changing work by the Financial Services Culture Board over 8 years, many financial institutions have learned how to shine a light on their organizational culture, identify weaknesses, and address them. And this matters as we look ahead, perhaps more so than ever. Think about the rise of fintech companies, which has nudged traditional banks to become more customer-centric, to transform their tech, to develop partnerships and collaborations with new fintechs. And there's cyber, with cybersecurity absolutely fundamental in banking. Yet as fast as banks and all businesses adopt more sophisticated safeguards against data breaches, those who would commit them find yet another way. And those solutions not only have to protect our institutions, but they must also avoid creating harm for our customers, colleagues, counterparties, because that's what the Code of Professional Conduct and the Consumer Duty require of us. I spoke earlier about the asymmetry of information between banker and customer. However, some bankers today might not quite feel they know more than their customers when it comes to AI. In fact, our businesses have been using AI-related technologies for some time in managing fraud, analyzing marketing trends, data collection and analysis, risk management and compliance, predictive analysis, and more. But the stratospheric rise in focus on AI over the last year, the ease with which we can individually access and play, for instance, with generative AI, has increased the digital heartbeat of our industry. But we still have to navigate through economic uncertainty and volatility on a global stage as the world stutters towards net zero and beyond, and we have such a major role in making that happen. I began with a personal story about my taxi ride in London 15 years ago. I knew then, and understand all the better now, that however much we use and are used by AI and digital tools, banking is delivered by people. We have to maintain our grip in that wider context. We have to remain in charge, in control. So I'll finish with another journey of a different sort. ChatGPT, sorry. I hadn't yet made time to play around with it. So I decided before starting work on these comments to do just that. I gave it the topic I'd been given, provided the context, and requested a speech. It responded in the blink of an eye. The speed was incredible, but what it produced was a bit curious. It gave me a short document structured like an outline that one would have learned as a school child, using language that to my ears sounded about 50 years out of date, far too formal. I don't mean to criticize, however, because it also pulled out some of the key themes I intended to talk about. Did I use any of its content? One sentence, because it was the only sentence that sounded a bit like my voice, and it was one that I could verify. We're all immersed in the world of AI far more than we've realized, but we see it more directly now through foundation-based models such as ChatGPT and the ongoing debates about blockchain, about tokenizing securities and other real-world assets, about all the change that's yet to come. The industry is indeed transforming at pace, but every new thing has a good side and a bad side, so we mustn't be lured into complacency. We can't let technology, the digital underpinnings of our business, even with all their benefits and the excitement of AI, however inscrutable it is, we can't let that make us forget that it's we who have agency. And with that agency comes responsibility. We mustn't lose sight of that again. 15 years ago in that taxi, I believed that most bankers were good ones, but there needed to be work to regain our reputation, to earn trust once again. Today, in the world of AI, cyber, sustainability, economic volatility, geopolitical upheaval, and more, If we operate to the Institute's code of professional conduct, we will keep our determinism, keep our humanity, and keep the confidence and trust of those we serve. I can't think of anything more important.